there's been a lot more warning signals about the U.S. economy and how recession is looming, leading economic indicators and other red flags, whether it's rail cars, bankruptcies with farming companies. There was another milk producer, Borden, just went bankrupt, and also a lot of other signals with capex cutting. But the one that caught my eye last week, and this is definitely a leading economic indicator, is this story about the Purchasing Managers Index and how that fell to June 2009 lows. So this story came out on January 3rd, 2020 from Reed Pickert. Hopefully I pronounced that all right. U.S. factory gauge unexpectedly falls to lowest since 2009. U.S. manufacturing closed out a tumultuous year with the weakest monthly performance since the end of the recession, with orders shrinking and factories continuing to dial back production. The Institute for Supply Management, or ISM's, Purchasing Managers Index, and that's a leading economic indicator, fell to 47.2 in December from 48.1, the fifth straight month of contraction, and missing estimates for a rise in a Bloomberg survey of economists, according to a report last Friday. It was the worst reading since June 2009 and marked the eighth decade in the last 9 months. And marked the eighth decline in the last 9 months. Readings below 50 indicate activity is shrinking. The deterioration was driven by the weakest gauges of new orders and production since April 2009. The data show American factories remain plagued by pullbacks in business investment at home. And we've seen this across the board with capex cuts. A lot of companies, whether it's Apple's doing massive amounts of share buybacks, increasing the dividend. A lot of other companies are not making capex investments, especially oil. There was a lot. The data showing an enormous amount of oil capex cuts. Occidental Petroleum, I think on Wednesday, just announced big layoffs. So there's been a lot of capex cuts. Capex cuts are normally what fuels the economy because that's investment, that's jobs. Companies are investing to either maintain property, plant, and equipment or to grow. So that's real investment, and normally capex, capital expenditure, means real jobs. Data show American factories remain plagued by pullbacks in business investment at home, softer demand throughout the world. We know the global economy is slowing down, especially China and emerging markets, and until recently, an escalating trade war between the U.S. and China. I still think the trade war, even though Trump is still occasionally issuing a press release, obviously, about a trade deal in phase one, obviously he's been busy the last 4 or 5 days with Iran and Iraq related things. So I'm going to play some audio clips in a little bit, but there's just so many headlines here that show that there's a lot of red flags, a lot of warning signs that the recession is coming, even though the yield curve's not inverted. Actually, there was a good jobs number, surprisingly, that came out on Wednesday. So the U.S. private payrolls post largest gain in 8 months. So this might be an outlier, though. U.S. private payrolls increased by the most in 8 months in December, pointing to sustained labor market strength, though job gains last month were likely flattered by a seasonal quirk. The ADP National Employment Report on Wednesday showed private payrolls jumped by 202,000 jobs last month, the largest gain since April, after an upwardly revised 124,000 rise in November. Upward revisions, red flag. Private, we don't know all the mechanics that go into these upward revisions. Private job growth averaged 163,000 jobs per month in 2019, slowing from an average increase of 219,000 in 2018. So the amount of job growth is declining, and a lot of it's probably the birth-death model. I'm not sure if the ADP jobs numbers use the birth-death model. No, the Bureau of Labor Statistics does on their non-farms payroll, and there's almost always downward revisions later for the jobs numbers. Economists polled by Reuters had forecast private payrolls advancing only 160,000 last month, following a previously reported 67,000 rise in November. So it beat the estimates by over 40,000. ADP private payrolls tend to surge in December because of adjustment difficulties related to the purging of employees who have permanently left company payrolls, according to economists. Some companies keep workers who have resigned on their payrolls until they file year-end tax documents. In contrast, in the government's more comprehensive employment report, workers who are no longer getting paid are dropped from the data. So if you want to read more of this article, I'll put it in the information and description section about the jobs numbers being good. Normally, if the ADP jobs numbers are pretty good, the non-farms payroll numbers, which are supposed to come out, I think, on Friday, normally those are fairly correlated. Occasionally, you will get a rarity where they're not close at all, but normally they're fairly correlated. Because I believe, according to Dave Kranzler, who I've spoken to about this, he says they use the same formula. They use the same software and formulas. So let me read some of these headlines about the real economy, and then I'm going to play this audio clip from David Rosenberg. Actually, it's an interview. It's about 7 or 8 minutes long. It's really good. He highlights a lot of the problems in the U.S. economy right now in the real economic data. He's one of the few Keynesians I actually like, because he's data-driven. A lot of these other Keynesians are like Paul Krugman, who's apparently now more like John Maynard Keynes than we realized. A little late night humor here, adding that. I'm not going to mention the P word because I don't want this podcast demonetized. Okay, so also, and in spite of this and all these real economic issues, we have the Dow, which is almost at 29,000 already. Could be at 29,000 very, very soon. It's at 28,745, up 161 points on Wednesday. So we're probably, in spite of the real economy having all these problems here in the U.S., the stock markets become basically more, the U.S. stock markets especially. I think a lot of the data showing that the U.S. stock markets are accounting for almost all the rise in stock markets now. That the U.S. stock markets, in spite of the real economic data, are totally become more and more totally divorced from reality on a daily basis. Also, despite what the dollar bears have said, the dollar index is now at 97 again. 97.28. Go figure. I was told by all the dollar bears, especially the chartists on the dollar index, who were showing me that there's no way the dollar index would be above 97 again. There was a lot of people, actually, who were showing me charts on Twitter. There's at least 5 or 6 in a very short amount of time who were adamant that the top was in, and that the dollar index would not be above 97 again. But I've been telling them it's a little bit more complicated than just dollar collapse, than just, January 20. I have a very good feeling, let's just say, that January 14th is going to come and go, and there's not going to be a collapse on January 14th. Why? The Fed already issued a new press release with repo stuff. Well, I mean, there was more repo again. So Zoltan was right that there still is repo problems, and the Fed issuing those press releases on... We didn't get a new Fed repo press release yet. We probably will soon, probably in the next 1 to 3 weeks, with even more repo. That would be my guess. But none of the repo problems were solved. The Fed, with that increase in repo on the press release in mid-December, after they read Zoltan Posnar's newsletter and changed their policy and announced an even larger repo program 2 or 3 days later, they bought themselves an extra couple weeks, and the repo problems are going to bounce right back again. Okay, so let me read these headlines first, and then I'll play the audio interview from David Rosenberg and talk about that. The audio from David Rosenberg is about a month old, but it's really good. So this headline is, the farmers are really upset that with Trump's $28 billion bailout. This one is the average U.S. family can afford a home in 71% of the country. These are about rail traffic. So rail traffic moves goods across the economy here in the U.S. Now, some of it is a lot of it is commodity driven. So some of those commodities do not have good supply-demand fundamentals. But for the mid-December, the amount of rail traffic was down 11.3% compared to 2018. So total carloads were down 7.2% compared with the same week in 2018, while U.S. weekly intermodal volume, containers and trailers, was down 11.3% compared to 2018, according to the Association of American Railroads. And they compile the data weekly. So the worst market in 30 years for 400,000 commodity rail cars sit idle amid industrial recession, which was at the end of December, that story. And then obviously the PMI, Purchasing Managers Index, numbers were just really bad. Although the jobs numbers were pretty good, but the jobs numbers probably are temporary and may be revised downwards later. You also have the Borden, so the bankruptcy with Borden. So Borden was a U.S. milk producer. They're the second big U.S. milk producer to file for bankruptcy. They're the second one to do so in 2 months for competitive pressures. Declining consumption and falling profits made its debt load unsustainable. known for its mascot, Elsie the cow, Dallas-based company. The other one was also in Dallas. Can't remember the name off the top of my head since it is pretty late. And I did just work out for 3 hours at the gym. Thankfully, I had a protein shake before I started this. The company, founded more than 160 years ago, said in a statement that normal operations will continue while it works out a recovery plan. It's just really sad. That's 2 big milk producers that are bankrupt now. So finally, let me play. There's a lot. Again, these are all symptoms of the real economy, that the real economy is not doing well here in the US, despite the jobs numbers. While the stock markets continue to soar, the US stock markets continue to soar and get more and more divorced from reality on a daily basis. And by the way, the data that's showing is that almost all the stock market gains now for the last couple of years are all the US stock market only. So let me play this audio now. It's very interesting.
Welcome back to Weekly. Joining me now to chat about the economy in 2020 is David Rosenberg, the chief economist and strategist at Gluskin Sheff. Thanks for coming back onto Weekly, David.
Thanks for the invite, Andrew.
So I know several issues caused you to be quite circumspect at the bullish U.S. jobs data last week. Of course, that's the way markets took the data. And when reviewing the equation for GDP growth, consumption plus investment, plus government spending, plus net trade, in looking at the states, only the letter C is working at this point in time, consumption. And I agree that consumption growth is slowing down in the back half of 19 and will continue to do so in the front half of 2020. But I still get the sense that, at least for the first half of 2020, consumption can enable the US economy to continue to grow at, call it 1.5% on an annualized basis. You agree or you disagree with that?
Well, I think that 1.5% is more or less a consensus type of forecast. And if you believe that potential GDP growth is, say, closer to 2, you're still going to get more disinflation pressure. The unemployment rate's going to stop going down, it'll go up. And, 1.5%, when I started in the business in the mid-'80s, when you got to like 1.5% growth, which I guess people today marvel at, we used to call it stall speed. When you got to 1.5% growth decades ago, you'd be thinking about, well, when's the recession going to start? And today people are jubilant when they hear 1.5% growth. I think that it's going to be weaker. I still think that recession risks are elevated. And in fact, what's interesting is that when you go to the New York Fed recession model, it's as high today, it's call it roughly 50%. Now it's down from 80, where it was in August at the peak. Interestingly enough, recession odds are actually the same today that they were a year ago. And the stock market's 25% higher.
Right.
But the point that you make is an appropriate one. The consumer, 70% of GDP, half of that 70%, call it 35% of US GDP, never goes down in recession. Because think, when you're talking about the consumers hanging on, think of what consumers spend money on. They spend money on rent. They spend money on utilities. They spend money on healthcare. They spend money on education. Those 4 things are half of consumer spending. And they never go down in a recession. In fact, those things didn't go down in the 08-09 Great Recession. So you can understand, to get an actual GDP recession, all the other things in the economy have to go down by quite a bit. So when you're talking about, for example, well, the consumer is hanging on in the aggregate, that much is true, because they're not cutting back on the essentials of life. But we got the retail sales number, for example, and for November. And what's interesting is that when you look at the cyclically sensitive parts of spending, not the necessities, not the pharmaceuticals,
clothing.
not the clothing, restaurants were down again.
Yeah.
When you take a look at the stuff that we want but don't need, so we're talking about the cyclically sensitive parts of retail sales. Well, they're running negative over the past 3 months. And what you're seeing is a more defensive tilt. And that's what happens in the consumer right now that I'm noticing, is that there's a more defensive, shall we say, consumer staple bias going on, even though consumer spending isn't declining outright. But I'll say this much. I do think that the components of GDP and the economy don't operate in a vacuum. You don't go through a capital spending recession like we did in the US and not have a lagged impact on employment. And I think that's going to come next. That's why I think your 1.5% might be off base, is that we haven't seen the lagged impacts of we had rolling recessions in the past, not just 12 months, 18 months. We had a recession in housing in the United States. People don't even know that in the national account data, housing has been negative for 6 of the past 7 quarters. And that's a quintessential leading indicator. We had downturn in commercial construction. We know for a fact there was a downturn in business investment. And look what exports have been doing over the course of the past half year. Now we'll see, maybe this trade deal over soybeans turns things around. I'm quite skeptical on that. But you see, all these things have a lagged impact on other parts of GDP. Okay, the economy is like a living thing, it's an organism. So I actually think that we're going to have more problems for this so-called Brazilian U.S. consumer next year than what's currently priced in.
Right, so, but does it drop off the cliff in the second half of the year as it gradually declines during the front half? Or do you see problems sooner than that in the U.S. economy?
I think that, well, nothing's going to fall off a cliff, okay? So I'll make that point right now. But you come back, for example, to what you said about the non-farm payroll report. Now, I saw a lot of non-ratification in that payroll report, and I actually found that there was a lot of growth in very low value-added industries.
Right.
I mean, waste management, leisure hospitality, health.
Low-paying jobs.
Low-paying jobs. And just like the retail sales numbers, all the growth are in areas of the economy that actually are non-cyclical, which is very interesting. Right. But if you believe, and I think most economists do, I mean, everybody was just marveling over last week's non-farm payroll report. If you actually believe those numbers, you have to believe that productivity is declining at roughly a 1.5% annual rate. By the way, after the fractional negative in the third quarter, so people say, well, there's no recession in GDP. Well, I got news for you. We've had a recession in corporate profits all year long, and there is a recession in productivity. Productivity is going down if you believe those numbers, which tells you what, as an employer? It's telling you that you have overstaffed. There's going to be a price to be paid for the second half weakening in productivity. Of course, not being reflected in the stock market for a whole range of reasons. The stock market long ago stopped being an economic barometer. But productivity declining means this, that companies are going to rationalize on labor in 2020. That's going to come back to a rising unemployment rate, receding wage growth, and the consumer is going to slow down. I'm going to say that, no, not the 50% of consumer spending that is devoted towards rent and food. That's not going to go down. But the stuff that's dedicated towards, luxury goods and services, those are the areas in the market I'd be avoiding next year.
So what about the consumer balance sheet in the States? We see that the aggregate data is in decent shape, but if you quintile it, is the U.S. consumer in better shape from a financial perspective?
Well, so that is that's the narrative that you hear, because this cycle has been a deleveraging cycle.
But the top quintile is clearly rocking, right? What about the middle and lower deciles and quintiles?
Well, of course, they're in a much greater stress and disarray, and they didn't benefit from the equity wealth effect that the higher wealth or higher income echelons did. But let's just look at the aggregate data, and the point I'm making is this. People say, oh, well, look at U.S. household debt to income ratio. It's come down from its peak of, say, 12 years ago. That much is true. But the U.S. household debt-to-income ratio is the highest it's ever been for this stage of the cycle, in every cycle in post-World War II history outside of 2007. So, if you like to compare U.S. household balance sheets to the credit bubble peak, what we call the mother of all credit bubbles in 07, if that's what your benchmark is, well, go knock yourself out. But this is actually the second highest peak in household debt-income ratio on record. It's like people saying to me, oh, well, the valuations in the stock market aren't as bad as they were during the dot-com, so don't worry about it. Really, that's what they were saying in 2007, if you remember.
I understand.
So I would say, actually, on a historical basis, household debt is still problematic. More so in Canada, by the way, but it's still a constraint in the United States.
Okay, so that was a really good 7-minute, 53-second interview. He covered a lot of interesting topics in a very short amount of time. Some of the things that I noticed the most in that interview, first of all, he is one of the few rational Keynesians, David Rosenberg. He actually goes through the data and tries to look at it in a more objective way. He also said that the GDP for 2020 for the U.S. is only projected to be about 1.5%. And he was saying that in the past that would have been considered really bad in a recession, stall speed, as he called it. And then he highlighted the amount of CapEx investment. He called it an investment recession. This goes back to capital expenditure or CapEx. So he said that the jobs numbers have created a lot of lower paying service jobs, and that the data is showing that consumer spending, while consumers are still spending on rent, on healthcare, on food, on utilities, the basic necessities, education, the basic necessities in life, that people are cutting back on the discretionary items. And also that was interesting about housing here in the US and debt to household GDP levels. That's increased a lot in China, but here in the US it's also high. I think he said in Canada that the debt to household levels are also at record highs as well. So there's a lot there. I'll put a link to the video if you want to listen to that interview again after the show's over. There's a lot of interesting stuff in there for traders. But the US right now only has a 1.5% GDP projection for 2020, apparently, and he is not very optimistic. David Rosenberg is about those numbers. And I think he just left his chief economist job, and now he has his own economics firm. So he's being an entrepreneur. Kind of like John Williams of Shadow Stats, except I think he'll have more clients. Okay, so let me take a look at listener questions and comments. And again, the stuff that's affecting the real economy is not affecting the stock market. So the Dow is in a very big upward trend now, and we could be at Dow 29,000 in a very short amount of time, but this has absolutely zero to do, in my opinion, with fundamentals. Now, if there's a good headlines jobs number, we could be at Dow 29,000 within a week or two on Friday if there's a good jobs headline. There's a lot of headlines of people losing jobs, companies cutting back on investment. It's all over the place. It's a lot of companies and a lot of industries here in the U.S. And the global economy, a lot of companies outside the U.S., this has already been happening for a while, but now it's starting to hit the U.S. pretty rapidly in the last couple months. Okay, I'll look at listener questions and comments, and then I'll shut down the show. And all the links that I talked about, some of the stories and the headlines, will be in the information and description section after the show's over. Crazy Ant asks, could these drops be because China's economy is getting worse, dragging us down because they are getting hit really hard? Emerging markets and the European emerging markets are getting hit really hard by China. Europe is a big exporter to China, and they're getting hurt really hard, plus the tariffs that the U.S. is putting on, plus all the craziness with negative interest rate policy by the European Central Bank. So China slowing down or contracting violently, depending upon what data you're looking at in their economy, that's hurting emerging markets the most, in my opinion. Which Mr. Fatface, a funny name, which doomsayer is looking more right, Peter Schiff or Brent Johnson? How about some of them are occasionally right? I've said this for a long time. Do not rely on any one person. If you just rely on Jim Willey, or you just rely on Bill Holter, or you just rely on Bix Weir, or you just rely on Catherine Austin Fitts, or you just rely on Peter Schiff, or you just rely on Brent Johnson, and you get your information from 1, 2, 3 people that have very similar confirmation bias, you're going to lose a lot of money very quickly. Maybe occasionally you'll make a lot of money, like with Max Kaiser and his bets on Bitcoin, or some of the other people who may have time to bet correctly. But if you only rely on 1 or 2 experts, you're going to lose a lot of money very quickly. You're not going to also get a whole picture, because some of these guys do not study all the things that they claim to study nearly as much. Like Peter Schiff. Peter Schiff has been repeating, I haven't listened to him on China lately, but for years he was repeating all the same talking points about China, and things have changed a lot in China in the last 10 years. And I think Peter Schiff's a smart guy. He's built a successful business, but China has a lot of problems now. An enormous credit bubble. China's doing so many different types of bailouts that they literally she just hired 12 new bailout czars. Okay, because they can't even keep track of all the bailouts. That's how crazy things are in China now. I'm working on a video with some of the headlines, tracking this since May of 2019, of all the different types of bailouts China's doing, and there's a lot of them, so it's still taking me some time. I added in a couple more slides. I think I'm up to like 9 or 10, and then I have to record the audio and edit it. Hopefully I'll get it done in the next week. But there's so many different bailouts and so many different levers that the People's Bank of China, the Chinese banking regulators, all the different powerful bureaucrats in China are doing, that it's very, very tough to keep track of them all. And even by what she just announced, with the new 12 financial experts that are hired, that's admitting that they can't keep track of them. They have to bring in help. Well, I was just ranting about gurus. So if you believe, there's tons of people who tell me that Bill Holter's right all the time and Jim Willey's right all the time, but some of these other, Peter Schiff is right all the time. Like, some people just believe they're one or two gurus. And I've lost money believing a lot of what some of these guys have said in the past, and that's why I've had to study and learn on my own and interview a bunch of different people. So I don't trust any one person. I try to look at the information in different ways, try to look at the counter argument, and then of course what's most important to me is people's track record. So if they're sticking their necks out and they're making predictions that, like, there was a bunch of people in the gold community, I don't remember all their names, but there was a bunch of people in the gold community, what was it, June or July? And they were saying everything will collapse by June something or July something of 2019. They were running these promotions, and all these people were telling me that everything was going to collapse by June or July, and then people were emailing me like 10 different articles in the same email. Someone just emailed me 10 different articles about January 14th, all the predictions made about collapse. Look, someone just emailed me about January 14th, not June 14th, January 14th. About, like, now the gold community and silver community, there's a bunch of people in there that they're coming out with newsletters and email blasts and podcast interviews. Everything's going to collapse by January 14th. There's only another 5 days. Do you really think the Fed's not going to issue more press releases with repo madness? I mean, the dollar hasn't collapsed. The Fed can get away with it. The Fed's balance sheet is obviously going to keep increasing. I don't know if it'll increase this week officially. But, the reality is the balance sheet is increasing. We don't know how much without an audit. But right now the Fed can get away because of this dollar tug of war and some of the other problems and how much demand for dollars there is globally, or otherwise all those foreign companies will collapse immediately if they don't make payments on their dollar bonds and the off-balance sheet dollar liabilities. That the Fed realizes, Steve Mnuchin even said this in the last couple weeks, he said there's a lot of demand for dollars globally. Well, I've outlined why. So they know that they can get away with just issuing press releases with more repo and increasing the balance sheet. The balance sheet is not to 2009 QE levels of 4.5 trillion yet officially. It's not there. It will be in 4 months or less at the pace it's on now. The balance sheet is growing officially at 100 billion per month. So in less than 4 months, the Fed's official balance sheet will be over 4.5 trillion. Yes, long-term, this is good for gold. Long-term, central banks increasing their balance sheets is good for gold. So is negative interest rates, so is inverted yield curve. All those things are good for gold, in my opinion. And temporarily, it's good for stocks. U.S. stocks, at least. I also think there's a lot of flight capital that's still coming into the U.S. There's a lot of printed money out of China, emerging markets, European Union, other countries that are coming into the U.S. and buying the Dow, buying the S&P 500. So that's printed money coming in from other countries. Doug Nolan, that I interviewed a couple weeks ago, he was talking about how there's so many different repo markets all over the world in Europe and Asia, and there's hedge funds borrowing from those repo markets and investment banks borrowing from those repo markets, and then they buy stocks in the U.S. That's what Doug Nolan was saying. So that has nothing to do, again, this has nothing to do with the real economy. A lot of the data with the real economy in the U.S. is that it's basically already in a recession. The only thing that's not in a recession is the stock market. There's a lot of red flags and warning signals going off, an increasing amount of them, actually, in the real economy here in the U.S. Especially with the big one is the CapEx spending, because eventually the CapEx spending means that maintaining property, plant, and equipment, or maintenance CapEx, that those assets will not be properly maintained, and that means human beings will not be there to maintain said assets. So human beings will be asked to take pay cuts or lose jobs. That's how important CapEx is. So the leading economic, to wrap this show up, because I don't want to spend too much time, but to wrap the show up is a lot of the leading economic indicators for the U.S. economy, besides the stock market, a lot of the real-world headlines, the real-world economic data in the U.S. is getting worse, except for the jobs numbers, but I'm very skeptical about the jobs numbers that came out, and probably because this ADP jobs number was good, the non-Bureau of Labor Statistics, non-farm payroll on Friday will probably be good too. Normally, they're pretty close. The numbers are pretty close. Occasionally, there'll be a divergence, or they won't be correlated, but normally, most of the time, they're pretty close. But I just think it's interesting that you have Hedgeye, you have so many other chartists on the dollar index saying that the dollar index would not go above 97 again. The dollar rally was over. The dollar was in a permanent decline. You know, all the budget deficits. And here we are. The dollar index is above 97 again. Pretty strongly above 97. So we'll see if it holds. But again, I think we're into this dollar tug of war. We've been in this, well, the dollar tug of war is still ongoing, I mean. We've been in this tug of war now for 2 years at least on the dollar index. Probably paper price smash. I didn't see the gold price. I don't really care too much about the intraday. Yeah, looks like there was a smash in the gold price. The gold stocks got hit. Wow, Royal Gold was down 7.14%. That's a lot. Coeur d'Alene down almost 9%, minus 8.71%. The gold stocks got pretty smashed. A lot of them are down 5% average, looks like. Right around 4.5 or 5%. A lot of them. Even Franco-Nevada, which is the most bulletproof gold stock, I did a video on this, was over the summer, 6 or 7 months ago, minus 3.12%. By the way, Franco-Nevada was up, I think it's what, 92 to $100. It was like 92 bucks like a couple months ago. Stock just keeps chugging along. Oh, I got a couple super chats. Thank you. Thank you, Ron, for the super chat. I appreciate it. I think Ron's a Patreon account contributor. So thank you very much to my over 200 Patreon account contributors. Hopefully it'll be over 300 in less than a year. That would be one of my goals for 2020, over 300 by the end of 2020. Daniel asks, first of all, Daniel, I cannot give financial advice like that, so I can only give my opinion. Are you still at the same job? So what advice might you have for someone with a 401k that they can't direct how it gets invested? Trade-off being that if they sell to cash, it gets held as cash in that account without tax penalty. So first of all, are you still at the same job? Can you roll over your 401k that you have to a IRA? Yeah, so that complicates things. If you could roll to an IRA, if they did change jobs, the IRA investment retirement account or individual retirement account would give you more options, a lot more. Oh, man. Yeah, the options are so limited, unfortunately. It's intentional. It's very frustrating. I don't like the system. This defined benefit. Excuse me, defined contribution. The old system was defined benefit. I would not go to all cash. I would not go to all cash. That's, we don't know how much longer this could go. You don't want to go to all cash. It's being dangerous all in on anything. It's being dangerous all in on gold. It's being dangerous all in on silver. It's being dangerous all in on Bitcoin. It's being dangerous all in on stocks or bonds or real estate or cash. That's not diversified at all. So no, I would not go to all cash. But the point I made with this show was the stock market in the U.S. is bucking the trend of the global economy, the global economic data. It's bucking the trend of other stock markets. The U.S. stock market's going up while other stock markets are not. And the U.S. stock market is bucking the trend of the leading economic indicators in the real U.S. economy, and it's bucking the headlines and the real economic data that we're seeing from the U.S. economy. It's just ignoring a lot of that, and it's still going up. And this is a lot of very similar to what happened in 1927 and 1929, prior to the October 1929 crash. So we are in the roaring 20s now, and unfortunately, I think a lot of the same mistakes are being repeated of the 20s and 30s. It is very tough to have diversification options in a 401k. They may have a gold mining stock mutual fund. You might be able to, there might be a higher commission gold mining stock mutual fund. You may want to look into that. But normally, unfortunately, when I was a investment advisor representative, there was not a lot of options with 401ks. But you may want to look into see if there's a gold mining stock mutual fund. There may be that option. That would be better than nothing. Although you're probably paying high commissions for that. But most 401ks do not have that option. The tax penalty would be enormous. I mean, ideally, you want to roll that over to an IRA, individual retirement account. I don't like Tesla. I'm not short Tesla. I don't like Elon Musk. Let's just leave it there. Is Tesla stock a good buy for the long term? Just because it's going up, you want to buy it? Because Cramer's pumping it like crazy now? After Cramer, like 4 or 5 months ago, called Elon Musk a fraud? It's ridiculous. It's ridiculous how phony the stock markets are, and Tesla and so many of these others. It's ridiculous how phony everything is. Oh, thank you, Dixie. Thank you for the kind words. Okay, we got one more super chat from La Petite Silver. Interesting name. Are you French? I sure appreciate all your hard work. Thank you. Well, you're welcome, La Petite Silver. So, looks like we're going to have Dow 29,000 for absolutely zero fundamental reasons. Well, unless you count fundamentals as companies borrowing more debt to do share buybacks, with the ratings agencies not downgrading their credit rating, and also some of these companies are borrowing to pay their dividend. Like, that's going to end well. These dividend payout ratios on some of these companies, I don't have time to go in there and look at all these large cap stocks that are paying big dividends, but these dividend payout ratios have to be right around 100% or higher. If they're over 100%, I mean, that's a ticking time bomb for these dividend payout ratios. Jonathan asked a good question. Why not all in precious metals since both stock and bonds are so overvalued? It's a good question. Depending upon which country you're living in, if you live in the United States, the tax situation for gold and silver, if you're ever planning on selling it, is really, really bad. And the U.S. government at some point could decide that they want to tax it even more. So it's very dangerous if you're an American and you live here in the U.S. and you have all your metal here in the U.S. that all of a sudden, ex post facto, the government changes the rules on you and you're SOL, shit out of luck. And the Bitcoin people and the crypto people, especially Bitcoin people, are, if they have millions of dollars in Bitcoin profits that they have not cashed out, they're in some of the same boat. You could have millions of dollars or more in profits in Bitcoin that you have not sold. And then ex post facto, the governments decide that anyone holding Bitcoin or certain types of cryptocurrencies is a criminal, is an illegal, is a tax dodger. So if you're holding these cryptocurrencies that government doesn't want, I hope you have 2 or 3 passports. So if you have a lot of profits in crypto, this is just my opinion, not financial advice. I would suggest if you have a lot of profits in crypto, you have 2 or 3 passports. And you have an exit plan to get out of your home country, especially if it's the US or some of these other countries, because at some point these countries could decide that anyone who's holding gold or crypto could be a criminal. Or they could put windfall profits taxes. This is why I always talk about this. Rule number 1, the governments can change the rules. So if you're all in on Bitcoin or all in on gold, and you're in a country where the politicians have decided that they're going to force everyone into the fiat currency system, and you did the right thing and you own a lot of money in a lot of your assets in gold or silver or crypto, maybe you were lucky and you timed the crypto right up, And then all of a sudden, the governments, because you didn't sell out or cash out or diversify, the governments decided that you're a criminal now, you're a tax dodger, you're evil. Actually, they can change the rules on taxes ex post facto. So they could always change the tax laws on you. And then your option would be to not be a tax dodging criminal, to probably give up your citizenship. But if you already have multiple passports, you can get out. Oh, wow. Singapore, gold and silver sold tax-free. That sounds pretty good, except Singapore has taxes on everything else. There's ways, normally governments, especially the US, I don't think they will necessarily rapidly confiscate gold or silver. I think it's more likely that they will try to increase taxes. They want these governments want tax revenues. Move to Puerto Rico. There's problems with Puerto Rico too. Okay, I have friends who moved to Puerto Rico, and yes, they saved on tax bills, but there's bad infrastructure there and other problems. I think one of the, was it Peter Schiff or Michael Maloney, they had to bribe someone to get their internet connection up? So there's problems there too. There is no perfect place. We're in an environment where governments are desperate. They're trying to trap people in the system, and especially the larger, more powerful governments can change the rules anytime they want. And no one wants to hear that because it's not easy, and people want an easy solution, like just buy gold or silver, and gold's going to $87,000, Bitcoin's going to 1 million, and you're gonna get rich. People want to hear that because it's easy. You buy one or two things, and you just wait. You pick your favorite one or two gurus, and you're gonna be rich in 5 years or 10 years or something. But that's not how the real world works. Also, if I made predictions like that, people would stop listening to anything I said. My track record would be total garbage. And yet some people have some people still make lots of money in spite of having track records like that. I guess my marketing is not very good. Probably why I can't get to 30,000 YouTube channel subscribers. Anyways, I want to thank everyone for listening, and I will look at what I'm going to cover tomorrow. Probably tomorrow will be an update on the Fed's official balance sheet, and we'll see what type of repo madness or not QE the Fed was up to. Stalemate IB says 30,000 Dow or 30,000 Wall Street for Main Street YouTube channel subs first. Well, I only need under 300 new subscribers for 30,000. And the Dow still needs over 1,000 points to get to 30. Dow's almost to 29 though. So I got a good shot to beat the Dow to 30,000. I got a decent shot. Not sure it'll happen, but maybe. But thankfully, I have my Patreon and PayPal contributors who are helping me. So it's not as required as much. I can just do rants like this and not worry that my channel's not growing as much. I need the sky is falling headlines daily. No, thank you. I don't want to tear my track record to shreds. I would rather stick with like more reasoned, measured predictions. Or analysis, more reason measured analysis and predictions, like how silver was going to be at $18 6 months when I talked about that 6 months ago, 6 or 7 months ago. I thought that was a reasonable prediction that silver would be at $18 6 or 7 months ago, and I thought it was a reasonable prediction that gold would be at $1,600. I was a little bit off on gold. I got silver about right. And I have no problem admitting I'm wrong, unlike most people in the gold and silver community who want to email me and call me liars. Who want to email me and call me a liar for criticizing them and their track record. Okay, well, that's it for tonight. End of rant. Thank you, everyone, for listening. And the David Rosenberg interview, if you want to re-listen to it, that was a month old. That will be at the last 30 seconds of this video, probably about 10 or 15 minutes from now. And the other articles will be in the information and description section.